Welcome back to class. Now we are going to be discuss about the role of accounting records. Why that is important. Why we need to be record the business transaction. We are all discussing already in chapter number two. Chapter number one in importance of bookkeeping and accounting record. Again, that's some touch. Establishing accountability for assets and transaction. First thing is that. More important for recording the business transaction, you need to be create accountability for the assets and transaction, what are a company assets and the possible related the transaction in assets, liability and on equity. Then the keep track of the routine business activity. Again, for the better accounting information, you not need to be miss any routine business activity for mean to say every business transaction, every business activity that will be able to record, you need to be recorded. Obtain detailed information about particular transaction, that's a part of your investigation. If the transaction is a fine, it will be correct or a correct amount. Okay, and evaluate the efficiency and performance with the company, because all these information we are creating just for the company performance will be better, and we can take a efficient decision and maintain evidence of a company business activity. What will be your decision, what will be your better controlling and monitoring decision, that all are basically some providing these accounting information, providing some evidence to the managers, to the company expert who will take a good decision about the company. Okay, that's all we are discussed about the role of accounting record. Now we come on a accounting cycle. That's a complete step of accounting cycle that you need to be understand in a financial accounting, which kind of step it is a basically a helpful to creating a step by step different step sequence of different step that we are able to make the accounting information fine. Accounting cycle, that's a sequence of accounting procedure that used to record, classify and summarize accounting information in financial report at regular interval, in often termed as the accounting cycle. Okay, and that is basically starting from the initial business transaction, recording the business transaction, and a whole procedure methodology will be adopted. At the end, your result, mean to say your financial reports will be come out, and you can take a good decisions. Okay, and the accounting cycle, what the step of accounting cycle. Now I briefly discuss in accounting cycle step, and further your lesson notes, and further coming your chapter we will discuss about the detail, and we will do a good practice of these accounting step. Fine. Journalization, it is the first step, that is the journal entry. Okay, journalization, journal entry, in which we will creating a just a business, identify the business transaction, and then further you will go record the business transaction. How the procedure you will be adopt in a journal when you make a journal entry, we will discuss it later. And after the journal entry, you will be post the ledger. I mean, to this is a process of a posting where you will be post your each ledger account, each journal entry into the useful appropriate ledger account. Okay, ledger account basically providing the summary. Okay, it will be providing the summary of each account. What is the account, we will also discuss it later. Okay, but the posting, the second step, the posting the ledger account. Fine. After that, the third step is the trial balance. You need to make a trial balance, that just producing the is your debit and a credit side of the account are equal or not. Okay, class. And the fourth step is that this brown one is the adjustment entries, adjusted account. Okay, adjusted entries. Now we need to prepare the adjusting month and year end adjustment entries. What is the importance of adjusting entries, and how we can difference between journal entries and the adjustment entries at the time of your starting the accounting cycle? You will be know about the difference, better difference about the journal entries and adjustment entries. Fine. After the adjustment entry, you will make to adjusted trial balance. Adjusted trial balance is a basically the step will come after the adjustment entries, and you can do it in a different normal as a traditional way, and also in a computerized worksheet method. Adjusted trial balance. Fine. After the adjusted trial balance, we will learn about the financial statement. It is a time where you will be able to prepare the financial statement, mean to say statement of cash flow, income statement, and a balance sheet. It is a six step of accounting. Okay, accounting cycle, six step where you will be make the financial reporting. After the financial reporting, closing entries and closing books will become. It is a year end basically closing return. We have some accounting accounts that we are using for just for the maximum 1 year, maximum one accounting period. After that, we when we will shift in a another physical year, another accounting period, then these accounts will not be useful for us, so we will close these accounts. After closing trial balance. Okay, after closing trial balance, it is a basically report of your detailed account that is mentioning, that is representing all the permanent account. Okay, then again your physical year will be start, and you will be start the generalization, posting trial balance. This cycle is basically repeatedly whenever you are making the accounting cycle, you are doing this cycle on a continuous basis. Fine class. It is a accounting cycles that I am talking about, the accounting cycle. Now I just want to talk with about the ledger account, because the journal entry we will discuss how we will do. But ledger account, it is a classification, basically a report of a single account. What is a account? First thing is that we need to understand account are a just and reveal record that show the increasing and decreasing. You know, the student, when we are basically record a business transaction, first thing is that we need a account. Okay, like that have a different name. Like here is a basically a folder, look like it's a form of a folder, cash folder or a cash account. Okay, in a cash account, in a cash ledger account, it is a detail about the cash, where cash will be, how we can receive the cash, where cash will be disbursement. Okay, mean to say your cash inflow, your cash outflow, all things are basically are detailed about the cash in and cash out in your this company, your company, and a particular transaction about the cash will be in cash ledger. Okay, whenever you use the account cash ledger account, the entire accounting record called the ledger. All records of increasing the account capital now focus use of account how we can use the increases are recorded on the right side of the account in the field. Let's see that when the account is just included at the and increases are recorded. Okay, increases are recorded in a debit side, and increases are recorded in a credit side, normally in a cash account. Increases are recorded on a one side of a T account, and decreases are recorded on the other side of a T account. Okay, we are right there, increase and decrease stand in a right and a left side of a T. Okay, but how we can discussing about the, it is a debit side, it is a credit side, we can get help from the normally the accounting equation. Okay, in your next slide I'm discuss about this. Look there, in a double entry accounting equation, basically in accounting, when you need to be record the business transaction, we need to be record this business transaction with the help of the equality of a debit and credit. Okay, what is a debit and credit in a positive manner? What we say why it is a credit. Okay, first, double entry concept rule is basically for debit and credit are designed so that every transaction is recorded by the equal dollar amount of debit and a credit. The reason of this equality lie in the relationship of the debit and a credit rule to the equation. Now I'm discuss about the thing. Uh, I mean, like, okay, we go on a next slide, then we come back. Okay, class. Like, in your accounting equation and your balance sheet, that's a balance sheet we discussed in last week. Okay, like it is our assets are resources like cash, your note receivable, okay, your account receivable, your supplies, your office equipment, building and land. We are not know about the definition of asset. These are economic resources, and company are going to be acquired these resources to take future benefit. Okay, every company, every person, even you are talking about the personal income of a person, he need to be increase their assets. Everyone want to become a rich and do a your good effort. What you think about this? Okay, everyone, now how I can increase my assets. Okay, in your personal asset, you have a bike, you are basically doing the work for a hard work, and you want to get a car. Okay, if you have a small car, you want to shift on a big car. Okay, it is a basically what you are doing, you are increasing your asset worth. Fine. No, if talk about the business also want to increase the asset their assets. Okay, in form of a cash, land, building. That mean to say increase in asset, it is a sign. If any business want to increase in asset, then what you say, it is a kind of this sign we use it. Okay, it is a positive sign. If we want to increase in a business, okay, increase in a business means to say increase our asset, because asset is a our property, it is a on business on thing. Okay, if you have a $300,000 asset, then you want 350 $400,000, it's mean your business worth is going to be increased because your asset are increased. Okay, so assets is a positive sign. And any business, if the asset are going to be increased, it's mean business is going in the good work, and business are increased. Okay, business is a profitable business. Fine, it is a positive sign in accounting. Anything that show a positive sign for the business, we will call it as a debit. What we say, it is a debit side. Debit side or a positive side is the same thing. Okay, now I am going to tell you people by this definition that asset increase is a positive sign, or in business any positive sign in which your business worth will be increased, we will represent in a debit side. Okay, it is a debit, it will be considered as a debit. So the asset is a debit side. In a debit, all assets are debit in closing, and it is by equation, it is your left hand side. Okay, it is your left hand side. Another thing, it is your left hand side. Okay, by equation, if we talk, it is the your right hand side. Okay, of equation, it is your right hand side. In equation, okay, it is your right hand side, and it is our asset side is our left hand side. I already discussed it. Okay, it is your left hand side. Now talk about the right hand side. We have liability and honor equity in our right hand side. Liability mean to say your note payable, your account payable, salaries. By liability, what is the definition? It is a negative cash flow of a business. It's mean our current obligation, our due amount that a business need to be paid in future time. ऐसे ही था ना? Okay, liability is your negative sign. It is a negative basically for the business. As your and liability will be increased, you will not be happy. It is a basically amount you need to be paid in future time. credit amount, it is your supplier, your vendor amount, it is your creditor amount, it is the amount that you are basically get in a form of a loan. These all amounts you need to be pay in a future time. So we can say it is account payable, salary payable, note payable, debt financing, whatever. Okay. If we talk about the honor equity is also a capital stock. If you are doing a good business, okay, you are with the help of the amount of your honors, you are getting the right hand side. With the help of your right hand side, we are basically get the left hand side. How we make our asset, how we purchase the land and a building with the help of capital side. Na? I mean to say, honor are invested in a business. Cash will become $150,000 cash come in your in cash account. Then with the help of this cash account, you purchase the land, building, office equipment, supplies, whatever. Okay, it's mean you are with the help of honor equity. You are with the help of right hand side liability plus honor equity. You are financing your left hand side into such asset side. So if you are doing a good business, it is a profitable, then you need to be give the profit to your owner, as well as the you need to pay back the liability. Okay, if you're not doing the business, then what, business is going to be closed. How you will do close mean to say that is not profitable business. Then you are purchasing some assets with the help of the capital stock. Then you sell these assets, land, building, office equipment. Okay, these assets will be sold and the owner will be get their money back. Fine, it is a business rule. So we can say business, if the business is a successful in a running in a successful form, performing the well, then business will be a profitable and owner are enjoying the profit. But if the business is flop, then owner will be losing that. Okay, will be get money from the business and business will be same. Okay, that is a point in which we can say your honor equity is also a negative for the business. Okay, negative for the business if owner take money back. Okay, it is a negative sign. So the right hand side is your liability and honor equity, both are your right hand side, and negative cash flow for the business term. Anything that is creating a negative cash flow, we will say it is your credit side. What we say, it is your credit side. Now I guess you will learn about the concept, and you can get a concept about the debit and credit. Debit is just a positive sign for the business that will basically showing the increasing in your business, and credit is a negative sign of a business that will show as a negative cash flow. Fine. Now we can go back. So our final finding is that our assets are the left hand side, and our assets are the debit, and our liabilities and our equity is the credit. Okay, now come back, like your asset is the debit balances, your liability and plus honor equity is the credit balances. Again, title of account with the help of accounting equation, we have two sides, right side and a left side. It is your right hand side, it is a credit side in which your liability and honor equity will become. Okay, and your left side, it is a debit side in which your debit side is coming. Okay, debit side means to say your asset side. Fine, that's all about discussing about the double entry concept. Double entry concept, when you will pass any transaction, your debit and credit are will be equal. Rule of debit and credit mean to design that your in every transaction you will be record equal amount of debit and credit. When we will do a transaction, first thing is that we need to be in a double entry concept. We first find the minimum two, at least two account. Okay, at least two account that will be used, and then we will decide in second step which account will be debit and which account will be credit with the equal amount. Fine, these are the accounting equations and double entry concept, and further we will discuss the debit and credit rule entries. Okay, but it will be discussed in the next slides. Okay, Allah Hafiz for this video, and start I'm checking third video of this lesson. Okay, Allah Hafiz.